Already this year, we have seen the results of the WEF Global Risk Report. For the first time ever, the top 5 global risks in terms of likelihood are all environmental. And just last week, Larry Fink stated that in the absence of robust disclosures, investors, including BlackRock, will increasingly conclude that companies are not adequately managing risk. So with that in mind, I'm thrilled to introduce you to today's webinars and present our speakers. Gemma Rastelli is the Senior Manager in the Sustainable Finance team at HSBC, covering the group's environmental, social and governance approach. In this role, Gemma is responsible for the annual disclosure of the ESG update, ESG investor relations and the TCFD for HSBC. Nontokozo is Corporate Engagement Manager here at the Climate Disclosure Standards Board, where she supports companies with reporting on climate-related and environmental issues. And I'm Leslie McKenna, the Communications Manager at CDSB, and I will be your moderator for today. We will also take Q&A at the end of this session, so we do encourage you to submit your questions using the Q&A function on the right-hand side. If we do not get an opportunity to address all the questions at the end, please do feel free to reach out to us directly and we can happily assist you. So before we dive into the presentation, I invite all participants to participate in this short poll to help us understand your knowledge around the TCFD. This will not be public information. This is just a short poll so that we know kind of what resources and tools that we can develop in the future to help you assist with your disclosures. So now you can see that I have opened the poll. How would you describe your understanding of the TCFD recommendations is the question. So you can select from I'm an expert, I'm confident, I have little knowledge, or I have some knowledge. And as I mentioned, this isn't for public information. This is just for us to help you on your journey. So the poll will be open for the next 2 minutes. So thank you very much for everyone who has participated so far. I can see the answers coming in. And with that, I am going to pass you over to my colleague Nontokozo, who will present on our work here at CDSB and investigate a little more the current state of TCFD disclosure to date.
Thank you, Leslie, and to all of you that have kindly joined us today. Before proceeding onto the recommendations and today's elements of focus, it's important to start with a bit of background about who we are, which should provide some context on why we're actually presenting on these topics. We are a consortium of 9 environmental and business NGOs set up in 2007 at the World Economic Forum in Davos, having observed a strong link between climate change and financial performance and the existence of a gap with regards to integrating issues, these kind of issues into annual reporting. We're chaired by the World Economic Forum and are supported by a technical working group of over 40 experts. Some of the experts and board members can be seen on this slide. Our work at CDSB is summarized by our mission, which is to create enabling conditions for the integration of decision useful and natural capital information into mainstream reporting. We achieve our mission by offering a framework for reporting environmental and climate information in the mainstream report. As you can see on the slide, we have the CDSB framework, which consists of 7 principles and 12 requirements. The 7 guiding principles are about the how of disclosure. Then we have the 12 reporting requirements, which are about the what of disclosure and mainstreaming climate and environmental information. The framework is fully aligned with the TCFD recommendations and principles. Also interesting to note is that the TCFD recommendations were actually developed based on the CDSB framework and other leading reporting frameworks. Therefore, you'll see that the CDSB framework can actually be used in a complementary manner with the TCFD recommendations, as well as other reporting provisions such as CDP, GRI, and SASB. The framework is referenced in the EU NFR directive guidance and by stock exchange guidance globally. Next slide, please. Next slide, please. So why were the TCFD recommendations introduced? Why are they important? Over the past couple of years, we've seen an increased acknowledgement of the need for climate action. and even with the most ambitious of policies, it's starting to seem unlikely that we'll be able to limit global warming to 1.5 degrees. According to Climate Action Tracker, policies presently in place are expected to result in about 3 degrees warming above pre-industrial levels. These climate-related issues have a potential impact on financial stability, which has meant that the role of investor capital allocation decisions has become even more apparent, as has access to decision-useful climate information. Investors and other financial players seeking this decision-useful information have actually faced several challenges, and some of these can be seen here. Lack of disclosures on the financial implications on climate-related aspects, inconsistencies in disclosure practices, lack of context with regards to the information, and also use of boilerplate and non-comparable reporting. So it's against this backdrop that the industry-led Task Force on Climate-Related Financial Disclosures was set up by the Financial Stability Board. It was set up to develop a set of voluntary, consistent climate-related financial disclosures that would be useful to investors, lenders, and insurance underwriters in understanding material risks. The recommendations were launched in 2017 and have received widespread support, and they also considered best practice actually on climate governance globally. Next slide, please. The recommendations consist of 4 elements: governance, risk management, strategy, metrics, and targets. The thing you notice about the 4 elements is that they are similar to traditional organizational descriptors. This is deliberate as the recommendations are actually meant to fit into the existing language of business. The second aspect is that the elements are shown as a concentric circle because they are interconnected and not meant to be considered in isolation from each other. Then there are other things to note about the recommendations, some of which I've already touched on. For example, they're voluntary. Although this voluntary aspect is something that is you know about the recommendations, it's also important to be aware that the governments around the world have actually started to conclude that a mandatory approach is needed to ensure necessary uptake at scale. Disclosures are meant to be made in mainstream reports. Several G20 countries actually already require public companies to disclose material information in mainstream filings, and this may also include climate change. The task force intended that the recommendations support these existing country requirements. There's an expectation that disclosure in mainstream reports would ensure that climate-related information is subject to controls similar to those applicable to financial information. The recommendations are for all companies, but with focus on financial and high-risk non-financial sectors and how these might be affected by transition and physical risks. Opportunities emerging from climate change should also be disclosed, and not just the risks. The task force also recommends that companies conduct scenario analysis to explore how the different combinations of climate-related risks might affect the resilience of the company. Companies must describe short, medium, and long-term climate-related risks and opportunities. The TCFD recommendations do not define time horizons, but rather suggest companies consider what is relevant for them and their assets. Disclosures can be both quantitative and qualitative. Next slide, please. So what does market practice look like? The second status report was released in June last year to monitor and inform progress against the recommendations. The report focused on financial and non-financial sectors, my apologies, that are potentially most affected by climate change and the transition to a low-carbon economy. There's some key findings that we would like to draw your attention to that you can see on the slide. Despite support for the TCFD rising, companies are still finding it a challenge to implement the recommendations, resulting in insufficient disclosure for investors. Secondly, more clarity is needed on the potential impact of climate-related issues. The majority of companies do not disclose information on resilience, and mainstreaming climate-related issues requires the involvement of multiple functions. So we can see that uptake at scale is urgently needed. We have a globally agreed framework, but companies are not using it as intended. Next slide, please. When you analyze the disclosure breakdown by sector and region, as you can see here from the status report, you can see that Risk management disclosures, in particular, when you look at the banking sector, they were actually the strongest. The banking sector actually performed well across all the elements, and this is likely because of the existing processes and structures that characterize the sector. We can also see a higher rate of disclosure in the EU. Next slide, please. Let us now look closely at the risk management element. This element actually happens to be one of two disclosures where there's no requirement for materiality in order to disclose. Risk management and governance are core elements which are about how, in terms of managing climate change risk and what internal processes are. They address the investor need for context in which financial and operational results are achieved, hence the lack of materiality requirement. There are three main disclosures under the risk management element, but these can actually be viewed in two parts. Firstly, how are climate-related risks identified, assessed, and managed. This refers to the first two disclosures, A and B. Then the third disclosure, disclosure C, is about how climate risk management processes are integrated into the overall risk management processes. Next slide, please. The TCFD recommendations include two types of climate-related risks, those related to transition to a low-carbon economy, known as transition risks, and those relating to the physical impacts of climate change, known as physical risks. For the benefit of everyone, it's useful to further clarify regarding these. Transition risks include policy, legal risk, technology risk, market risk, and reputation risk. Physical risks include acute risks, such as the increase of extreme weather events, and chronic risks, such as sea level rise. Next slide, please. Now, let's consider the three disclosures in a bit more detail. The first recommended disclosure is that companies describe processes for identifying and assessing climate-related risks. It suggested that companies include a discussion on the following: how the relative significance of climate-related risks versus other risks is determined, and the processes for identifying the potential size and scope of risk. It also suggests that companies discuss the following: whether existing and emerging regulatory requirements related to climate change are considered, a discussion on risk classification frameworks used. For example, with banks, the Enhanced Disclosure Task Force's framework for defining top and emerging risks could be used. Another suggestion for banks, although there's no reason why the approach should not apply elsewhere, is that banks consider characterizing their climate-related risks in the context of traditional banking industry risk categories such as credit risk, market risk, liquidity risk, and operational risk. Next slide, please. So when we come to the next aspect, which is the risk management aspect, how are the companies managing climate-related risks that they've already identified and assessed? The guidance on the recommendations suggest that when describing risk management processes relating to climate change, companies should consider including a discussion on how decisions to mitigate, transfer, and accept or control those risks are made, how climate-related risks are prioritized, and how materiality determinations are made within the company. A useful way to go about determining the relative materiality of climate-related risks and how these should be prioritized is by conducting materiality assessment and incorporating a materiality matrix. This is already being done by several companies, and ensuring climate-related issues form part of this is really just a next step. The final disclosure is about integrating or embedding the processes for identifying, assessing, and managing climate-related risk into overall risk management. In describing how climate-related risk management processes are integrated into overall risk management, we suggest companies take a direct approach or an implicit approach. A direct approach would mean the inclusion of a brief discussion regarding the inclusion of climate-related risk considerations into overall risk management processes. Or, as we've seen in some companies, you could talk about the risk management process broadly and then just mentioned climate change. Alternatively, where climate change risk can be included alongside the list of company risk types, it can be implied when discussing overall risk management processes that climate change forms part of that. Next slide, please. Since investors are the ultimate users of the disclosed information, it's important to be constantly aware of the information needs. What are these aspects, particularly regarding risk management disclosure, that investors have indicated that they'd like to know? We thought we should share some key takeaways on what constitutes decision useful information from investor survey on TCFD disclosure conducted by one of our board members, SASB. Survey respondents identified the value of having clear definitions of the categories and specific channels of risk the company identified as material. Greater clarity around the process by which companies prioritize risk and how this prioritization may change over time in response to actions taken by the company to mitigate these risks. More information about companies' risk management process informed about how that informs the board decisions around strategic resilience. Thank you.
Thank you very much, Nontokozo. And with that, I will hand you over to Gemma to present from the HSBC perspective.
Hello, everyone. As Leslie mentioned, I work in the sustainable finance team over at HSBC. My main focus is around both ESG disclosures and also our own TCFD reporting. I just want to check, are you all able to hear me okay? Are you able to hear me okay?
Yes, I can hear you loud and clear. Yes, so most of our participants can, but there has been a request from some, Gemma, if it's possible to increase the volume of your headset slightly.
Yeah, is that better? Is that any better?
Yes, perfect. Thank you very much.
Perfect. Sorry, thank you for that. So the first thing that I wanted to talk through, and I'll be brief because I know that the main focus of the discussion is around risk management in TCFD, but in terms of our journey and how we kind of walked through this from an HSBC perspective. Because the first thing that we think about, and this is more in terms of the breadth of ESG, is around what do our key stakeholder groups think about this item. So if we use climate as an example, our consumers and our customers are saying that more and more they're choosing companies who value both environmental, social and governance factors when they're thinking about how to manage their business. Our annual surveys with ESG investors suggest that climate is one of the top themes that ESG investors are interested in disclosure around. In terms of other stakeholders, the board and our non-executive directors continue to push us in the right direction on climate. It's something that our non-executive directors are continually questioning our approach to. And then also other internal stakeholder groups, our employees as well. So we run various annual employee surveys. Climate is something that comes up as a continual theme. What are we doing? Are we doing enough? And then also even just graduate events. I think we had our global graduate event around 6 months ago, 1,000 new graduates. Again, climate and environment was one of those topics that came up from that stakeholder group as something that's extremely important. They want to know what we're doing, are we doing enough, like are we in line with peers, etc. So it's really a topic that all of our stakeholders groups are extremely interested in. And obviously, as has already been touched upon, one of the other key stakeholder groups are the regulators and the governments. So as has already been mentioned, like TCFD could potentially become mandatory at some point. I know it already is in some jurisdictions. And also the UK Corporate Governance Code, the new Section 172 requirements forces the companies to think about all of these stakeholder groups and what's material to them. So we've conducted, as part of normal BAU, we obviously conduct a lot of different surveys with these different groups, and climate was one of those things that over the last few years has obviously become more and more important to each of these stakeholder groups. So that kind of led us to kind of the first circle, if you like, of the governance piece. You know, how can we ensure that our senior stakeholders in the bank are like, you know, they understand this item, and they discuss it on a regular basis. So in terms of the governance pillar, if you like, the first thing that we did, perhaps we could move on to the next slide, is ensure that this is talked about at kind of senior levels in the group, and I will go into that in a little bit more detail when I get into the TCFD disclosures. But in terms of the E, the S and the G, these were the key themes that the stakeholder groups fed back on. You can see the low carbon transition, and also our own operational sustainability is under the E. So I suppose the difference for HSBC is our own operational sustainability is the carbon emissions of our own buildings, the carbon emissions, you know, our own electricity bills, etc. Whereas when we talk about the low carbon transition, that's really what that looks like for our customers and our kind of loan book, if you like. So that's how we kind of break it down into two. I mean, really, that would be our scope 3 carbon emissions. And you can see along the bottom that each of these ESG metrics are embedded within our strategy. So that's the other kind of circle. What we've tried to do is ensure that in exactly the same way we have targets around profit and risk-weighted assets, these ESG-related targets are embedded within our strategy. So we have an 100 billion sustainable finance target as part of our strategic priority 1. We also have various social targets around improving customer satisfaction and employee engagement. And then also for the G, we have targeted ourselves to receive an ESG rating of outperformer according to Sustainalytics. So what we've really tried to do is, instead of thinking about ESG, any of these things as off to the side, we're really trying to ensure that these factors are fully embedded into our strategic priorities and therefore kind of our business. Next slide, please. So as I said, I just wanted to give a little bit of background as to how we think about ESG more broadly, and now I'll kind of dive into the kind of TCFD and climate piece within that. So as has already been touched on, climate risk breaks down into two key risk types, so transition risk and physical risk. And again, just to go back to the stakeholders, what we've tried to do is really think about how those two different types of risk might impact our key stakeholder groups. So to give an example, from a transition risk perspective, how much do our customers and our suppliers rely on high carbon fossil fuels, as an example? If tomorrow the cost of those fuels went up, or if tomorrow the supply of those fuels went down, how would that impact our customers, and how would that impact our suppliers, and therefore how would that impact us? From a physical risk perspective, thinking about, obviously we finance houses, and we also provide insurance products. You know, if there were flooding along kind of low-lying land around rivers in some of the key cities, how would that potentially impact our mortgage book? How would our customers be able to pay us back their loans? So we're really trying to think along those kind of two channels in terms of how that would impact us and therefore obviously our risk. And I suppose the key point is that just going back to the governance piece, what we've done at HSBC is we've ensured that climate risk is an entirely separate risk within our normal top and emerging risk list. So alongside geopolitical risk, as an example, or cyber security risk, we also have climate risk, and that is therefore is monitored and discussed at our key senior risk management meetings in exactly the same way as those other top and emerging risks are discussed. And again, we try and think about it in exactly the same way as we would any other risk type. How will this risk potentially impact our stakeholders, and therefore how will it impact us? In terms of our own kind of figures, in terms of what we've disclosed to date, so this is based on our year-end disclosure that I think we disclosed back in February. So you can see on the left-hand side, the first piece I wanted to talk through is just the opportunity piece. So we, as I say, we've targeted 100 billion. As at that point in time, we're 28.5 billion progress made. So that's more kind of how do we see the opportunity, because that's obviously the key way for a bank definitely to get our relationship managers on board, is to say it's not all about risk, it's about explaining to our clients that our strategy is to help finance our clients towards a low carbon economy. So it's not that as part of our strategy, we're walking away from those clients and those counterparties. What we're doing is we want to talk to them, we want to understand what they need, and what finance they need in order to transition, and then we can help them with that finance requirement. So I think it's key also to understand that it can be a key USP or a key kind of opportunity for a business as well as a risk. And then on the bottom left, you can see that that's kind of where we are in terms of our own operations. So we've got 29% of our own electricity is using renewable electricity to date. And then moving on to the right-hand side, so this is where we've focused on transition risk at this point. We believe that's the most material risk for us out of transition or physical. We are looking at both, but this is the one that we were focusing on first. And what this is showing is that of our entire wholesale lending book, which is around, I think, 600 or 700 billion, 20.8% of our loan book is to high transition risk sectors. So what we're trying to show there is this is our potential exposure to that transition risk. So these 20.8% of our wholesale lending book is exposed to transition risk. And what we wanted to do is really just get that out, get that discussed, show people that it is something we're taking seriously, it is something that we understand is something that we need to work on. And what we wanted to do is use this disclosure to then drive action as well, because I think once you kind of disclose externally, that drives a lot more discussion and a lot more action. So that's super helpful. The other thing that we do, obviously I've mentioned that climate risk is embedded within our top and emerging risks list. There's a separate team within our credit risk function who focus on transition risk. And what they've done over the last year is they've rolled out a transition risk questionnaire. And again, that's about us speaking to our clients and our customers and trying to understand how they think this may impact them and what they're doing about it, what's their strategy, what's their board policy, how are they thinking and understanding climate, and how can we help them. So we've rolled that transition risk questionnaire out to, I think it's a few hundred clients, and that's globally. And what we've done is, instead of it being a completely separate process off to the side, what we're saying is that as part of our normal annual review process, all of our relationship managers will speak to our clients on at least an annual basis, and they'll run through these certain questions. Exactly alongside that same questionnaire process, they'll be running through this transition risk questionnaire and asking our clients, you know, this is something we need to think about. What's your strategy? How are you thinking you're going to set your business model up to mitigate these risks? And how can we help you to transition? And I think that shows that what we're really trying to do, again, is instead of having, oh, you know, ESG off to the side or climate risk off to the side, we're really embedding it within our normal risk management function. Clients will expect to have those questions exactly alongside the normal annual review questions that they'd already be answering anyway. And then what we hope to do over time is obviously use that information that we get from the clients to help them on that transition, provide additional financing where required, and also help us with some of our disclosures and creating kind of more metrics going forward. So yeah, I think those were the main points I wanted to make in terms of the disclosure. And I suppose really, again, it's once you start to disclose, it will kind of drive more action and drive more discussions, and even I do believe quite strongly that what gets measured gets done. So once you start thinking about the numbers and start thinking, oh, hold on, how could this impact us? This is actually something quite material, as you can see for HSBC. It's not an immaterial number. So once you start just showing those figures, then the ball starts rolling and the kind of momentum starts really. But yeah, I'd suggest, I mean, I've just pasted in really our approach to climate risk management on the next slide. And then, so that kind of shows what we talked about, and you can see there in 2018 we developed the transition risk questionnaire, and then also on the next slide is our actual TCFD disclosure and what we disclosed for the year end 2018. But so I say in terms of the journey that we've come on, so just to recap, so we started out by saying just normal stakeholder feedback. What are our stakeholders interested in? How how has this topic emerged over time, and why is it important for our board and our risk committee to start thinking about this in a serious way alongside all of the other risks that they normally think about? Make sure they're discussing it on a continual basis, and then start to think about how do we measure that risk? How do we think about our exposure to that risk? And then really work with our customers to see how we can ensure that we're helping them on that journey. I think those are the main things I wanted to talk through. I'm not sure whether there's any questions or feedback at this point.
Thank you very much, Gemma. Yes, we've had quite a few questions come through. So I think quickly we will just go through the slides for kind of top tips for implementation. So as I mentioned, we do have quite a few questions coming through. So thank you all for giving us your questions. So very briefly, top tips for effective disclosure, and then I understand that Gemma had a couple of tips as well that she's happy to share with the audience.
Okay, so these are really just the tips that have emerged from our research and engagement with companies through the years. So I'm not going to touch on every single one of them, but some are key, particularly for today. Adopting the correct lens when looking at climate-related risks. We found that some report preparers get confused regarding the orientation lens for TCFD. For particularly for TCFD, we're looking at the impact of climate-related risks on the business, not the other way around, and also making holistic disclosures. The disclosures are interconnected, as I've mentioned earlier, and showing that connectivity is key. This includes linking non-financial information to financial information. And then I also spoke a bit about materiality assessments. So it's important to assess the materiality of climate change as a business, and this aspect actually tends to be missing in many reports with regard to climate change specifically. We encourage also companies to use existing standards to make disclosures. We believe that companies will find that they're already really doing and what they're doing in the build-up to recommendations, so they already have what they need to start off. It's also important to CFD like puzzle pieces, okay, that help you tell the story of how you assess, manage climate-related risks and opportunities. We encourage companies to make as many of the 11 disclosures as they can, because this sort of like puts all the pieces together to tell the whole story. And then finally, the recommendation of the TCFD is that the disclosures be in the mainstream report, as I've mentioned. So including these disclosures in the mainstream report allows for climate-related information to be put through as the same kind of rigor that financial information goes. So just to sum up, overall, we encourage companies to evolve their practice over time, to learn by doing, and not let perfect be the enemy of good. Just get started.
Thank you, Nontokozo. And interestingly, we did have a few questions come in about where these disclosures should be made. So they should be put into your mainstream report. And over to you, Gemma.
Hi, yeah, and I suppose just to add to that, that was a point that I missed. So yeah, our TCFD disclosure is part of our annual report in exactly the same way as all of our other risk disclosures. The 2 points I just really wanted to reiterate are the importance of kind of getting senior stakeholders engaged and on board. We find at HSBC that a lot of them are actually fully clued up on this topic, and they'll all be going through extensive training on this. But we also have run kind of specific training sessions with our holdings board, and then also with our group management board on this topic. We've got external experts in to speak with them, which I think has helped as well. And then the second point I wanted to make is just kind of ask those difficult questions, really. So just to give a couple of examples, if tomorrow the UK government introduced a high carbon tax, I mean, based on a company's emissions, how would that impact your consumers? How would that impact your customers? How would that impact you? it's something to think about. That's the question that I often ask people as well. The second is the regulators. If tomorrow the regulators introduced a high capital buffer for carbon emissions or a company's I mean, in the case of a bank, a company's kind of lending to brown or fossil fuels, how would that impact you? How would that kind of feed through your disclosures and your balance sheet? So it's just those kinds of difficult questions can kind of focus the mind. It's not something kind of fluffy that's a long way off. Tomorrow that could happen. So what would our exposure be? How would that impact us? What would our profits do in that event? It's just worth kind of thinking through those types of questions and asking those questions, and then it definitely kind of drives some discussion.
Thank you, Gemma. And I think that's always really useful to have those types of questions to put it into context. So in terms of if you want to learn more, I've just popped some resources up on the slide. Please do head to the TCFD Knowledge Hub. There you can access different types of case studies and resources to help you on your journey. They also have e-learning courses, so looking at climate-related financial disclosure, a more in-depth focus of the TCFD, and also looking at the role that the accountancy profession can play. We've also got the TCFD implementation guide that CDSB developed with SASB, and the Good Practice Handbook, which offers examples of good practice disclosure within your mainstream report. And then also finally to draw your attention to the Better Alignment Project report from the Corporate Reporting Dialogue that aligns and maps the 5 major standard setters and frameworks to help you implement the TCFD recommendations. And that brings us to our questions. I will talk through some of the questions now with Nontokozo and Gemma. As I mentioned, we have had quite a lot come through, so if we don't get to your question, please do drop us a line at info@cdsb.net, and we'll happily direct your question to the relevant person. So Gemma, the first question I will direct to you, and I think it touches on your point that you were saying around bringing the board on board. And when you're going to the board and to the risk management committee, how do you deal with someone who may potentially be a climate denier within your organisation?
So yeah, there's a couple of methods. One of them, I suppose, I've already touched on around just giving those 2 examples. So saying, okay, the carbon risk question, the carbon tax question, or the capital buffer question. But then the second is really just kind of picking whichever stakeholder group you think is the most important and kind of will potentially change that person's mind. So for example, you could say this is one of the top questions that our investors are asking. You could say this is something that regulators are pushing us towards. This could become mandatory from next year or whatever. Could obviously. And then also kind of customers, like our customers tell us that more and more this is something they're thinking about. They're going to start turning away and switching to different companies if it's not something that we're kind of disclosing on and kind of clearly communicating about. And then also employees, if you think that will kind of change their minds, they kind of say this is an important topic for our employees. It's something they often feed back on. Obviously, it's helpful if you've got some of those kind of survey results, etc., to back it up. But what we've found is that across all of those stakeholder groups, climate and what we're doing on that and the actions that we're taking is a key topic, and it's just becoming more important.
Excellent, thank you. And the next question that we have is around integrating climate-related risk management processes into the overall enterprise risk management strategy. So what would be a good way to start framing the discussion around this? And how do you integrate climate-related risk management within more traditional approaches? I think both Nontokozo and Gemma potentially could touch on that. So I'm not sure who would like to go first.
I can go first.
Okay.
If you like.
All right.
If that's okay, I'll start and then see. Just from an HSBC perspective, I think that's something I kind of touched on. So, what we've tried to do in terms of integrating is first of all ensure that this risk is thought about in exactly the same way as any other top and emerging risk, and it's monitored by all the same committees that would be monitoring cyber or geopolitical risk, as an example, and then the other thing is also making sure that our risk teams are fully trained and they understand that this is the same risk, and when they're looking at kind of credit approvals, etc., they should be thinking about this in exactly the same way as they would any of those other risks. And as I mentioned, we've rolled out this questionnaire alongside our annual review process to make sure that alongside the normal kind of questions that we'd ask our clients, we're also talking to them about their climate strategy, board policy, management plan, etc. So yeah, just trying to think about what are your current processes for managing risk, and how can you ensure that kind of climate's part of that as opposed to it being something off to the side?
Thanks, Gemma. Nontokozo, do you want to add to that?
The things that I would have said. So I was going to say looking at existing practices as well, governance, and looking at existing processes for monitoring and measuring risk, and trying to sort of see how you can integrate the risk management processes into that. So we're kind of aligned on that. Thank you.
Excellent, thank you. Well, that does bring our webinar to a close. We have recorded this session, so we will follow up with a copy of the recording and also a copy of the slides. Thank you to everyone who participated today, and as I said, please do feel free to reach out to us here at cdsb.net if we didn't get to address your question. And thank you once again for joining, and I do hope to see you at future webinars. Have a lovely day.